Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from the Federal Home Loan Bank of Chicago. It's not exactly a page turner, but stick with me because we're going to decode what their debts mean for the housing market and maybe even your wallet. Think of it as understanding the fine print before you sign that mortgage, except we're doing it for a whole bank. This is a Form 8K, which is basically a corporate oops, we need to tell you something important report. In this case, it's all about debt, specifically something called consolidated obligations. These are like IOUs the bank sells to get money. The main point of this report is to detail the bank's financial obligations, basically how much money it owes. The Federal Home Loan Bank of Chicago gets most of its money from selling these debt securities, known as consolidated obligations. Think of them as bonds and notes they sell to investors. All 11 federal home loan banks are responsible for these obligations. So if one bank can't pay, the others have to chip in. It's like a group of friends backing each other up on a loan. The Federal Housing Finance Agency, or FHFA, regulates these banks, and they can make any of these banks pay up if another one is struggling. These aren't backed by the government, so it's just the bank's own money on the line. Now, let's get to the numbers. Schedule A is where the bank lists all the bonds and notes they plan to issue. This doesn't include the short-term notes that last a year or less, which they issue all the time as part of their regular business. It also includes any debt they've taken over from other federal home loan banks. Let's look at some of the details. Remember, we are simplifying it. Alright, check out the table. There's a lot of information here, but we'll focus on the important parts. The trade date tells us when the deal was made. Then there's the maturity date, which is when the debt needs to be paid back. For example, on March 24, 2025, they made a deal for a bond that matures on March 8, 2030. That's 5 years down the road. The coupon rate in this instance, 4.375, is the interest they're paying on the bond. And the bank par at $20 million is the face value of the bond. So they borrowed $20 million at 4.375% interest. Here's another example. On March 24, 2025, they did another deal that matures in April 2028. The interest rate or coupon on this one is 4.6%. Again, they borrowed $20 million. One last example, another bond was traded on March 24, 2025 and matures in September of 2028. This one has a 4.75% interest rate and is for $15 million. Now, there are different kinds of these bonds. Some are non-callable, meaning the bank can't pay them off early. Others have optional principal redemption, meaning the bank can choose to pay them off early. The call style tells you when they can do that, like American, Bermudan, or European, each having different specific dates. These bonds use different rate types. Fixed constant means the interest rate stays the same over the life of the bond. It's predictable. There are variable bonds where the interest changes over time, or conversion bonds which change from fixed to variable. To make it clearer, constant means the interest rate remains fixed, easy peasy. Optional principal redemption means the bank might pay it off sooner. American means they can do it anytime after a certain date. Bermudan means they can do it on specific dates. European means only on one specific date. So you see, it's important to choose which one works best for the bank. Alright, that's a report. Now, what does it all mean? The Federal Home Loan Bank of Chicago is basically borrowing a lot of money. This is how they fund mortgages and other housing-related loans. The interest rates they're paying give you a sense of the market conditions. Higher rates mean it's more expensive to borrow. The types of bonds they issue and how they can be repaid show us how the bank is managing its debt and planning for the future. So what's my take on all this? The Federal Home Loan Bank of Chicago seems to be playing it relatively safe with mostly fixed-rate bonds. This makes their interest payments predictable, which is good. However, they are also taking on a lot of debt, as you can see from the millions of dollars in each bond, and rising interest rates could make things tougher down the road. One potential risk is if interest rates go up a lot, the bank's borrowing costs will increase, potentially squeezing their profits. On the other hand, if the housing market stays strong, the bank will likely do well as these loans will be repaid. Overall, the Federal Home Loan Bank of Chicago appears stable, but it's important to keep an eye on interest rates and the housing market. I'll Pierre. Thanks for watching. If you enjoyed, please subscribe, like, and comment.